Well, welcome everybody. Thank you for joining us for the next session of our Virtual Investor Series. For those of you who might not have joined us for our first several sessions, my name is Andy Langsford. I'm the founder of Venture Real Estate Group. We're a investment, development, and brokerage firm based here in the Great Northwest. And we're thankful to have Michael Gaberman with us. Michael's a private banker with Washington Trust Bank. Michael focuses a lot of his attention on real estate, construction, new construction financing, permanent financing as well if it's needed, as well as everything in between. A lot of real estate projects that we've worked on. Am I missing anything?
Land assemblage.
Land assemblage, definitely
Where
land
the value
assemblage.
creation is centered.
That's the biggest part, actually.
Sure.
That is definitely, no,
You're new at
I'm
this.
not just saying that.
You're
I
new
mean
at
it.
this.
So we're very fortunate to have Michael, and Michael's an avid tennis player as well. So I've yet to take a set from Michael.
He says that in jest. So.
And tennis is the greatest game.
Absolutely.
Absolutely the greatest game. So what we're going to do, we're going to be going over two real life examples. First session, we're going to be covering a smaller apartment project that we did, which was a 7-unit project in West Seattle that we syndicated. Next session after that, we'll be actually covering a 100+ unit project that we co-developed and just asking Michael some questions on the banking side of things. So we'll jump right in.
Sure.
So again, Michael, thanks for joining us.
Absolutely.
So on this seven-unit project, we'll jump right in. It was a 7-unit apartment syndication. Typically, we're doing larger projects, but this one really made a lot of sense. And we looked at this project, realized rents were way below market, and there was a garage there, and we're able to actually, literally, big garage with a toilet, turn this into an 8th unit, and just made a lot of sense. So we did the deal. We from a financing standpoint, we put $1 million down. We financed just over $1 million, and we're doing a value add deal right in the middle of the project. Are you seeing many value add deals currently?
I guess there's two ends of the spectrum. We're sitting here obviously in late October in 2020, so there's a lot going on in the real estate landscape. But specific to, let's say, a 4 to 10 unit multifamily project, a lot of people, depending on where their project's located, have a wide array of tenants, some that have their jobs and some that don't have their jobs. And so the occupancies right now, and what really defines a value add deal is a moving target. But with any good real estate investment, the money's made on the buy, and so approaching something as a value add from the word go really makes it a lot less risky from an investor standpoint, and in turn a lending standpoint. I've done one project in the last 30 days. It was only a 4-unit. It was in Capitol Hill, but it was completely vacant, and the client was doing a value add deal as well. And we just needed to be realistic about how long it would take to actually do the construction because of COVID real estate shutdowns, but also how long it would take to lease up because these units are going to be expensive units on Capitol Hill. And we were fine doing it for this client. They've got 6 or 7 other properties, and they're going to see a lift of 30% once this thing gets fully leased. It's going to take a minimum of 6 months, and so we were realistic and said, let's put it on interest only, at least for that period of time, and not start payments. And being a banker, let's put what money they were going to put in on top of it to carry the project, because the project was going to be vacant, as well as a reserve above what the construction budget was. Mm-hmm. And so, a short answer is yes, with caveats, especially right now, because you're seeing a lot of vacancies in the smaller units, in the 60, 70, 80% range where they've never been before. And it's really the Class A bigger units that are seeing the 90% plus occupancy right now.
Mm-hmm. No, seeing that. Yeah, we have a couple of vacancies that typically pre-COVID, we did a fantastic remodel, and the units were leasing up real quickly. But now it is taking more time on some of the smaller smaller project. That's just the truth.
And we're going into the Thanksgiving and Christmas season and into January. So I'm encouraging any clients that have any vacancies, sign the lease with the tenant, give them 2 to 4 months free rent, get the thing leased up, because anything that's going to be vacant right now will probably still be available in January, and there's no point in bearing the cost of maintaining the common area spaces and everything else. Have a tenant in there and have, when this thing from a health perspective turns, you're not out chasing for tenants at that point in time. If you can afford it, put them in with a big discount.
Yeah, get it leased.
Yeah.
Yeah, get it leased. No, it's true. Next question. In a small syndication like this, what makes it successful from your standpoint, from a lending standpoint?
Risk mitigation. Getting a good advisor up front to look at all the property specifics, all the structural specifics, and really assess the depth of the market. Where can we go with this property? Like building another unit in there. Mm-hmm. And then beyond that, it's being realistic about how much things are going to cost. We're seeing obviously large increases, especially in COVID times. I had a lot of clients start to buy building materials for a point in the project that was 6 months in the future, early in the spring, because they were starting to see costs escalate, and they were starting to see scarcity, because it's been very widely discussed that there's a slowdown in production. Mm-hmm. So, it's
costs go up.
Yeah, it's risk mitigation. And really that's just investing in the right partnership group, making sure someone's done this before, that they're accurate about what the project's upside and downside is, and then just managing it fairly tightly throughout the process. And I call it course corrections. Nothing ever performs as it's scripted from the beginning. So you want to be able to have an open dialogue with your syndication group and say, all right, this is different than what we assumed, but share with them the information and make sure everyone's engaged in the conversation.
Really good. Made me while you were talking, it made me think of your team. Mm-hmm. And who the contractor is, attorney. So, the team, wouldn't you say, seeing who's this person working with? It's
absolutely, and I'm a simple person. I mean, I go with people that I know and people that I like. And if I've used them before, and I know that there's a dialogue, because again, nothing is ever performs as scripted. As long as you can work through those issues and everybody has a common goal at the end, stick with that team and go forward.
Mm-hmm. No, it's good, really good. What can go wrong? Delays, for instance, West Seattle. Obviously, COVID. West Seattle, we have a bridge that is not working. Yes. So that's been an issue. But what have you seen go wrong in your deals? And
everything. I mean, obviously, common issues are lawsuits. If a general contractor is not paying their subs and the property gets liened, how do we get around this? Because the client wants to complete the project, get the CFO, get the permanent financing, especially right now when rates are as low as they are. Mm-hmm. So there's a wide range of things that can go on, but honestly...
Get the lien release signed by the contractor.
Yes.
Always. We work with some great contractors, but it's important to do.
And in our side of our business, we take an assignment of the contract between the developer and the general contractor. So we actually do the due diligence on the financial wherewithal of the contractor, because just like it was in 08, 09, 010, a lot of contractors didn't have the staying power and they were moving money around. So we want to make sure if we're going to finance a construction project, we want to do some due diligence on what's the depth of the capacity financially of the contractor. Mm-hmm. So if something happens to the developer, we can get them to perform. We've at least been honest up front and say, okay, this is either a strong contractor or a weak contractor, and we've structured our deal to accommodate that variability.
No, that's good. Yeah, that makes a lot of sense. What has changed now with COVID from a financing perspective?
So there was a big disruption in the beginning of the summer, especially with anybody that has a heavy retail hospitality tenancy in their projects, which is not in the apartment space, but there's a shadow effect to that stuff, because a lot of those apartment folks that are in a 7-unit apartment are typically working in a retail or hospitality space as opposed to a Class A apartment building. So there's a lot going on, and there's a lot yet undetermined at this point in time. Mm-hmm. The thing that made the individual apartment renter whole for a period of time was the PPP, the Payment Protection Program, but that was a very short-term fix, and there could be potentially another one after the elections this year. But these are the kind of things that you almost cannot forecast that could potentially go wrong in a project. And there's a lot of changes. I mean, the financing as a whole, if you're not lending your own money, which we do at Washington Trust Bank, you're at the whims of the capital markets and someone external to you making business decisions. We fortunately haven't stopped lending. We did $1 billion plus in Washington just in the PPP loan, and we're a fairly small bank, but we knew that if we were around to support those businesses, we could at least, when the market recovers, have a lot of goodwill that we could trade on with them going forward.
Yeah, absolutely. No, that's good. And yeah, PPP for sure, that made a big impact for sure. Be interesting to see what does transpire moving forward. Last question for this session. How have you seen investors maximizing their returns on deals currently?
Well, the most common thing right now is, since money is so cheap, either paying off the debt completely or finding a way to lever it up even more so. So if it's a long-term hold, get in some 10-year 3% money on the property, and even if the cash flow is break even, over time, if it's in a good location and you run the property right, you will get the tenant mix that you want, and the cash flow will expand in years 2, 3, 4, 5 as we get out of this COVID thing.
So levering up a little more based on rates and money being so cheap.
And based on the cash flow of the property. If the property isn't cash flowing or it's below 1-to-1 and there's something in the construction phase that's not going to work, de-lever the property at that point in time, just so that you can have the staying power to hold on to the property without having the bank tell you and dictate more so what to do with that.
No, that's exactly right. There's a balance there if you can, but an investor needs to know where that line is. So yeah, that's good.
Well, I'll just delve here for a second, but one of the things that a lot of investors don't do is they don't know how to measure their cash flow in the way that a bank like ourselves would underwrite it. And so what we do different is we don't underwrite our stuff to a tax return. We actually measure the cash flow, and we look back 2 years and look forward 2 years when we make a decision. And we have a conversation about what's going to happen in the next 24 months and get granular with the detail. And then we're very comfortable making a credit decision, because you can make a loan, but you're not lending money. There's a fine distinction between the two, and we would rather be lending money than making the loan. And it takes a lot more work, but you have a much more stable client, and the client's knowledgeable as to what the banks are looking for in good times and in bad.
Yeah, and the deal makes 100% sense, and that's key. It has to make sense. Really, should be a no-brainer deal, and it has to be a good deal.
I have a third grade education. If it's more complicated than that, then it's not gonna work.
Sure. Well, Michael, thank you.
You're welcome.
That wraps up the session. Hopefully you got a lot out of it. Our next session, we're going to be talking about a bigger project, a 100+ unit project. Hope you enjoyed it. We'll see you on the next one.